All right, today we're going to demystify a really simple but super powerful tool that's at the heart of, well, all business finance. If you've ever thought about starting your own thing or you just want to know how money really moves in a company, you are in exactly the right place.
So let's say you've got this brilliant idea for a business. You're ready to go. But then that reality hits you, right? How on earth are you supposed to keep track of all the money? You've got loans, sales, expenses. It can feel like a total mess. In the beginning, your finances probably look a little something like this, just a jumble of notes and numbers. It's basically financial chaos. And without a system, it's pretty much impossible to know if you're actually making money or if you're heading for trouble. So, how do we clean up this mess? Well, the solution is, believe it or not, surprisingly simple and elegant. We are going to meet the foundational tool in all of accounting, the T account. And listen, when I say simple, I really mean it. At its core, the tool looks exactly like this. It's just a giant letter T. That's it. This simple shape is what's going to bring order to all of that chaos. Now, okay, its official name is a ledger account. The best way to think of it is like a dedicated folder or a file for one specific type of transaction. So you'll have one T account for cash, another one for sales, one for rent. You get the idea. Each one is like a page in your company's main book where everything gets recorded and added up. So that T shape splits every single transaction into two sides. On the left, we've got debit, and on the right, we've got credit. Now, just for now, let's start with a really simple way to think about it. Debits are for things coming into an account, and credits are for things going out. But as you're about to see, it's actually a little more nuanced than that. So how do these two sides work together to create this perfectly clear picture of your finances? Well, it all comes down to one golden rule that makes the entire system work. It's this concept called double entry bookkeeping. And here is the magic trick. Every single financial thing that happens affects two accounts. So for every transaction, you make a debit entry in one account and an equal credit entry in another. It's kind of like a balancing scale. Every action has an equal and opposite entry, which keeps your entire financial universe in perfect balance. Okay, you might be thinking, how am I supposed to remember all that? Well, here is your secret weapon. Meet the Pearls mnemonic. It's an amazing cheat sheet. To increase any purchases, expenses, or assets, you debit them. That's your PEA. And to increase any revenues, liabilities, or shareholders' equity, you credit them. That's the RLS. Pearls. Seriously, this is the key to everything. All right, that's enough theory. The absolute best way to understand this is to just see it in action. So let's apply these rules to a classic startup, our very own lemonade stand. Okay, first thing we have to do is actually fund the business, right? So you take $100 of your own savings and you put it into the company. So let's see how this looks in our T accounts. Cash is an asset, and according to our Pearls rule, to increase an asset, we debit it. So, boom, we debit the cash account for $100. Now that money represents your ownership stake or your equity, and to increase equity, we credit it for $100. See? A $100 debit, a $100 credit. Perfectly balanced. Okay, next up, you can't really sell lemonade without lemons. So you head to the store and spend $10 of the business's cash on supplies. Let's get this recorded. Buying lemons is a business purchase, which falls under expenses. To increase an expense, what do? We debit the purchases account for $10. Simple enough. But where did that money come from? It came from cash. Your cash, which is an asset, is now decreasing. And a decrease is just the opposite of an increase, so we do the opposite of a debit. We credit the cash account for $10. And look at that, the scale stays balanced. And success. Business is taking off. A happy customer walks away with some delicious lemonade, and they hand you $20 in cash. Let's record our final transaction here. You got $20 in cash, that's an asset. To increase it, we debit the cash account. That's sale, that's revenue. And following our PERLS rule, to increase revenue, we credit the sales revenue account for $20. One debit, one credit. The balance is perfectly maintained. So, we've recorded all our transactions. We've got a few T accounts with numbers all over the place. So what? Why did we do all of this? Well, this is the part where we turn those simple T's into actual financial treasure. Let's just focus on our cash T account for a second.
To find out how much cash we actually have, we just need to balance it out. We add up the debit side, that's $120. The credit side is only $10. The difference, the balancing figure, is $110. We write that 110 on the smaller side, the credit side, just to make both columns equal. That is our final balance.
And that balancing number, $110, that's the answer. That's the whole point. After starting your business, buying the lemons, and making that first sale, this is the exact amount of cash your lemonade stand has in its pocket. No guesswork, no chaos. Just a clear, simple answer.
And this is why it all matters so much. These final balances from all of your T accounts, they become the literal building blocks for your official financial statements. The numbers that investors, banks, and you yourself will use to judge the health of your business, they all start right here. They tell the complete, balanced story of where your money came from and where it all went.
You see, the T account isn't just some boring accounting exercise. It's a tool for clarity. It transforms that mess of numbers into a story that makes sense. So now that you have the key to that clarity, what story will your numbers tell?